Welcome, Business 330 students. This is Professor Hasse. It's our week 4 weekend video for this business finance class for 2003 fall session. Today, we're going to do one more look at the definition of bonds, one of the major principal ways a company can obtain capital financing. We're going to review our assignments. Assignment 2 grades have been posted. Look over that, and then look again at assignment 3, which is due this weekend. And then take a quick look at what you'll be seeing in the next 2 weeks in regards to our course of study. So I hope everybody is doing fine. If you, again, if you have any questions or concerns, we're at the halfway point of our class. I welcome any comments or observations that you may have about the course. Remember, at this halfway point, please take a look at your grade situation. And if you have any questions about the grades you've received up to this far, now's the time to discuss with me what's going on there and what you as a student's options are halfway through our course. So again, we do have assignment number 2 grades have been posted to Blackboard, and in the assignment number 2 file folder are the solutions to that work. And let's take a quick look at those solutions. Assignment number 2 concerned itself with Chapter 5 and the time value of money. There were 10 extra credit questions, as you can see here, 10 extra credit questions, each worth 9 points. And then a portfolio question where you had to submit your spreadsheet of your portfolio evaluated as of September 8th, Friday, and that question is worth 10 points. So when you review your posted answers to your grade center and you see the amount of points taken off for those, you'll see where you stand in relationship to the overall assessment of the assignment. Assignment number 2 is worth 15% of your course grade. And again, each multiple choice question was worth 9 points, and the portfolio question was worth 10 points. And also, as you can see, the first 4 questions were from doing some specific calculations in regard to the time value of money. And I also included in the solutions a spreadsheet of those calculations so you could see how I calculated the information. And let's take a look at those. Here's the spreadsheet for the solutions for the first 4 questions where you're doing specific calculations in regards to the time value of money. Question number 1, what is the future value of $10,000 on deposit for 5 years at 6% simple interest? And that's where I got you in the problem. Many of you did the compounding interest over 5 years. In other words, first year interest compounded to the second year and so on. Simple interest asks you to just take $10,000 times 6% times 5 years, which is $3,000. Add that $3,000 to the principal, the answer is $13,000. That is simple interest. If we were doing compounding interest, you would use the future value formula, where you would take the rate of 6% over the number of 5 periods, with its present value being $10,000, and that would compound it over the 5 years, and the answer is question D. But since you see this phrase here, simple interest, that's what I wanted you to calculate in that problem. So the correct answer is $13,000. The second question is, what is the present value of your trust fund? Don't we wish we had all this? $50,000 on your 30th birthday, 7 years from today. It earns 10% compounded annually. Now, this is a present value problem. We're going to have $50,000 in 7 years. What is its present value today, discounted at 10%? So there we use the present value function with the interest rate being 10%, period 7 years, and now it's discounted the principal back at $50,000, $25,657.91. Another way of looking at that, if I take the future value, 10%, 7 years, and take the 25,657.91, which is the present value, and do that, voila, comes out pretty close to $50,000. So that's the answer to the second question, a present value calculation. Question number 3 is a little bit of a challenge, but I was very impressed. You all pretty well figured it out. You'll be receiving cash flows of $1,000 today, $2,000 at the end of year 1, nothing in year 2, $3,000 in year 3, nothing in year 4, and $6,000 in year 5. If that's discounted at 7%, what is its value today? What I did is I took the net present value function, added $1,000 to it, which is our $1,000 today, and took the net present value of 7% over the cash flows of year 1, 2, 3, 4, and 5, including the 0 in year 2 and 4. I get $9,412.27, and if I add that $1,000 to it, as you can see here in the cell, I get the correct answer of $10,412.27. The key there is knowing that you have to include zeros and include the 2 and 4th years with 0 to come up with your total number. And then finally, the fourth question, if I borrowed $120,000 for a home mortgage at 9% over 30 years, with monthly payments of $965.55, how much interest is paid over that life? Well, very simply, if you take the monthly payment, $965.55, and multiply it times 30 years at 12 payments a year, which is $360, you get $347,598. If I subtract that number by 120,000, the amount I'm borrowing, I get my interest payment, and the answer of $227,598. So there's no amortization schedule needed. It was assessing your ability to understand how you would do that, knowing that the monthly payments are $965.55. Calculate the total amount of payments, subtract out the principal, and there's your how much interest you'll be paying over the life of the bond, or of the mortgage. So that's the first 4 questions of your assignment number 2. And then the remaining questions are just some definitions of understanding the time value of money, and that's what I was looking for. They're pretty well self-explanatory. If you have any questions or concerns, let me know. But question number 7, you probably have to do the calculations for each one of these 4 using your future value of money calculation, and this D would be the correct answer. Remember, if you're doing quarterly interest of 2.25%, that would make the number of periods here 40 and the number of periods here 20, because it's quarterly at an interest rate per quarter of that. That's how you would calculate that amount. And the same thing for question 8, 9, and 10, having you do more practice in that regard. If any of you have specific questions about how I calculated these, please see me in my Thursday evening office hours. Then we get to our portfolio, and some of us are still having a heck of a time trying to figure out what we're doing here, even after multiple samples of the portfolio have been given to you throughout these first few weeks of our course. Here's what I'm looking for, and here's what I would like to see through the second assessment of your portfolio. Now you're going to be doing one more assessment, and that's during final examination week. One more time in that assessment, the only additional factor you'll be doing is trying to locate the dividends that have been paid through the 8 weeks of our class on your stock, just during that 8-week period. All right, here's my portfolio. First of all, it totals on August 25th, $100,000. There's the opening price on the 25th of my shares, in this case, Apple, Exxon, NVIDIA, and Walt Disney. And there's the number of shares rounded to the nearest whole number of what I purchased. There's the Dow, the S&P 500, and the NASDAQ indexes, which you should know what they are now from viewing the definitions in our Blackboard, week 1, 2, and 3. And here's my portfolio updated as of Friday, September 8th. Notice it's the same format. I just copied it down and changed a couple of things. First of all, I pasted the values of my shares down to here. And then I found the new share price for my 4 stocks at the close of business on Friday. Multiplied that new price times the original shares, and there's my new value. So as you can see, Professor Hasse is definitely not the Wolf of Wall Street in his portfolio as of after 4 weeks or 3 weeks of the course. I've made $863.46, roughly a 0.86% percentage gain up to this point in my class. I was looking for those two numbers. Secondly, I was also looking for the beta of your company, and some of you rightly put NA. If you couldn't find a beta for your company, that was correct. We'll be using this beta a little bit later on in our calculations in our course, but this is the beta calculation, or the risk of the company in comparable to the market risk. Market risk is 1. If your company has a beta higher than 1, it's a little bit riskier, a little bit less chance of success compared if it was under 1 in the market. Here's the Dow, and many of us had the wrong values for Dow. Remember what I said a couple weeks ago? You got to give about 5 or 6 hours after the closing bell on Friday to make sure everything is properly posted and closed. And there's the closing prices of Friday of the Dow, the S&P 500. And then I wanted you to tell me what was the percentage gain or loss of each of the indexes over these 3 weeks of the course. The Dow was up 0.66%. The S&P 500 was up 1.16%, and the NASDAQ is up 1.24%. And in your final analysis, your answer would be, did I beat the market? Well, in the case of Professor Hasse here, Mr. Hasse did beat the market, the Dow market. He did outperform the Dow index of 30 leading stocks, but I did not outperform the S&P 500 and the NASDAQ. I made money, but not much. So that's what I was looking for 10 points in your question about your portfolio. And I needed to see this spreadsheet resembling pretty much what you see in front of you. And again, for those of you who still are having a little bit of difficulty getting this format down, I have provided the spreadsheet in assignment number 2 file folder that you can copy and download and fit to your particular stocks. You're going to be doing this again, another segment, as of the close of the market on October 13th, Friday, October 13th, which will be the last valuation date of your portfolio. And you'll be finding the dividends posted to your account during that period of time, August 25th to October 13th. And then you'll be calculating again the percentage change in your portfolio, comparing it to the market, and we'll see who is the Wolf of Wall Street of Business 330 for this fall 1 session. So there is a completed portfolio, what I'm looking for in that work. Now, here's your work for this week. And again, at the end of week 4, when you post this up on Sunday, and I post the grades next week for assignment 3, 55% of your grade will be completed of this course. 2 more grades left. 2 more grades left. And let's see what that remaining work will be for our course. Here's what we have left in this course after assignment 4 is posted this Sunday. 2 more works. You have assignment number 4, which is a capital budget analysis, which is due October 8th, in 2 weeks from Sunday. Excuse me, 3 weeks from Sunday. That work will be posted in my Saturday video on Saturday, September 23rd. I will post that on the 23rd of September, due on October 8th. You roughly have 2 weeks to do that work. That will be a spreadsheet analysis based on my lectures of week 5 and week 6. It'll be a spreadsheet file that you complete. I will give you the template, but you will put together a capital budgeting analysis. This is on chapters 8, 9, 10, 11, and 12. Part of this work in assignment 4 will also be doing a one-page paper, I guess you could say, where you'll be writing an interpretation of what that spreadsheet is telling you about this particular situation. And we'll talk more about that in the coming week. But that will be posted on September 23rd, Saturday, a week from today. And it'll be due 2 weeks later on October 8th. That's 20% of your grade. And then the final examination is due Sunday, October 15th, and that will be posted on October 2nd. Monday, October 2nd, you'll have also 2 weeks to do that final examination. Now, part of that examination will be about the week of October 9, but you can get a head start on that work. I'll be posting the final on October 2nd. It is due 2 weeks later on Sunday, October 15th. So you have the next 2 assignments. You have basically 2 weeks to do each work. All right. And they're worth 45% of your course grade. So at the end of this week, assignment 3, you have 55% of your grade completed, and then 45% to go in the final weeks of our course. So that's where we stand currently as far as grades are concerned. So here is assignment 3, and it's pretty short. It's pretty short. Again, it's work that resembles or asks you about bonds and stocks. It asks you to take a look about the definition of bonds and definitions of how to calculate return and what certain key aspects of stock price and valuation are. Then I ask you to do a research question. As of the close of market yesterday, Friday, the 15th, what was the 10-year United States Treasury yield in a percent, and what does that yield represent to an investor? A little 1 or 2 sentence or a paragraph definition of what that Treasury yield represents. So again, this is assignment 3, working over the definitions of key capital components of business finance, stocks, and bonds. Speaking of bonds, here's one last brief video that's important about bonds that can give you a little summary again of bonds, because our first video talked both about stocks and bonds, but it didn't get into all the specific details. Wanted to do this because a lot of us don't have much experience with bonds. Bonds is not a very sexy investment. Its basically to get consistent or fixed income or interest payments. There's no real valuation involved. It's you buy the bond and then you kind of hang on to it. Not too exciting as far as investment is concerned. So that's why not too many of us know about bonds. But also it's a very important investment because it is fixed income, and many of our managers of our retirement funds hold on to a lot of bonds, which our retirement funds are invested in. For companies, it's the primary, and I stress that, it's the primary source of capital for many corporations. Let's take a look at this video.
In this video, I want to give you a general idea of what a bond is and why a company might even issue them in the first place. And just at a very high level, a bond is essentially a way for someone to participate in lending to a company. So you're a partial lender. partial lender to a company. And just to make that more concrete, let's imagine some type of company that has $10 million in assets. So these are its assets right there, assets. And it has $10 million in assets. And let's say, just for the sake of simplicity, it has no liabilities. So all of that value, all of that $10 million, is what is owned by the owners, or by the equity, the owner's equity. So this is $10 million, $10 million in equity. And if we had, let's say, a million shares, I'll write it down. If we have a million shares, and if we believe this $10 million number, that implies that each share is worth $10 per share. Now let's say this company is doing really well and it wants to expand. It wants to increase its assets by $5 million so it can go out and buy a $5 million factory. So it wants, let me draw it right here, it wants another $5 million in assets that it needs to build that factory, or essentially a $5 million factory. And the question is, how does it finance it? Well, one way is that they could just issue more equity. If they're able to get a price of $10 per share, they could issue another 500,000 shares, 500,000 shares at $10 per share, and then that would essentially produce $5 million. So this is scenario one. They issue 500,000 shares at $10 a share. They now have 1.5 million shares. But these new owners gave them collectively $5 million. So the equity would grow by $5 million. We now have 1.5 million shares. So this would now be 1.5 million shares, not 1 million. And that new money from these new shareholders would go into the asset side, and then we would use that to actually buy the factory. What I just described is essentially issuing equity, or financing via equity. Financing via equity, or by issuing stock. Now, the other way to do it is to borrow the money. To borrow the money. So let me redraw this company. I'll leave this up here just so we can compare the two. So once again, we have $10 million of assets. That's our $10 million of assets. We have $10 million of equity to start off with. $10 million of equity. And instead of issuing stock to get the $5 million, we're going to borrow the money. So we're essentially issuing debt. So we could go to a bank and say, hey, bank, can I borrow $5 million? So we would have a $5 million in liability. It would be debt, $5 million of debt. And the bank would give us $5 million of cash that we can then go use to buy our factory. So in either situation, the asset side of our balance sheet looks identical, or the assets of the company are identical. We had our $10 million assets, and now we have a factory. But in this first situation, I was able to raise that money by increasing the number of shareholders, by increasing the number of people that I have to split the profits of this company with. In this situation, I was able to raise the money by borrowing it. So the people that I'm borrowing this money from, this is borrowed money. Borrowed money. They don't get a cut of the profits of this company. What they do is they get paid interest on their money that they're lending to us before these guys get any profits at all. In fact, that interest is considered an expense. So these guys get interest. And even if this company does super, super well and becomes very, very profitable, these guys only get their interest. Likewise, if the company does really bad and these guys suffer, as long as the company doesn't go bankrupt, these guys are still going to get their interest. So they're going to be a lot safer well, they don't get as much of the reward as the new equity holders would. They also don't get as much of the risk. Now, this is just straight up debt, and you could just get this from any bank if they were willing to. If they said, oh, you're a good, safe company, we're willing to lend you $5 million. But let's say that no bank wants to individually take on that risk. So you say, hey, instead of borrowing $5 million from one entity, why don't I borrow it from 5,000 entities? So what I can do instead instead of borrowing it from one entity, I could issue these certificates. I could issue bonds. And that's the topic of this video. So I issue these certificates. They have a face value of $1,000. $1,000. This is my face value. Face value. Or sometimes you'll hear the notion of par value. And I'll say what interest I'm going to pay on it. So let's say I say it has a 10% annual coupon. Annual coupon. And it's actually called, even though this is the interest, I'm essentially going to pay $100 a year. It's called a coupon because when bonds were first issued, they would actually throw these little coupons on the bond itself, and the owner of the certificate could rip off or cut off one of these coupons and then go to the person borrowing or the entity borrowing the money and get their actual interest payment. So that's why it's actually called coupons, but they don't actually attach those coupons anymore. And then it has some maturity date, the date that not only will I pay your interest back, but I'll pay the entire principal, the entire face value. So let's say the maturity is in 2 years. So in this situation, in order to raise $5 million, I'm going to have to issue 5,000 of these, because 5,000 times 1,000 is 5 million. So times 5,000. So if you wanted to lend $1,000 to this company so that they could expand, and if you think 10% is a good interest rate and it's a safe company, you would essentially buy one of these bonds. Maybe you buy it for $1,000. And when you buy that bond for $1,000, you are essentially lending this company that $1,000. And if you did that 5,000 times, or if that happened 5,000 times amongst a bunch of different people, this company would be able to raise its $5 million. Now, just to be clear how the actual payments work, the coupons tend to get paid semi-annually. So let me draw a little timeline here. And this tends to be the case in the US and Western Europe. If this is today, this is today, this is in 6 months, this is in 12 months or 1 year, this is in 18 months, and this is in 24 months. And I'm only going up to 24 months because I said this bond matures in 24 months. So what is this? If you hold this bond, this certificate, what do you get? Well, it's going to pay you 10% annually, so $100 a year, $100 per year. But they actually pay the coupon semi-annually. So you get $100 a year, but you get half of it every 6 months. So you're going to get $50 after 6 months. You're going to get $50 after 12 months, or after another 6 months. You're going to get another $50 here. You're going to get a final $50 there. And they're also going to have to pay you back the original amount of the loan. They're also going to have to pay you the $1,000. So that last payment is going to be the coupon of $50 plus the $1,000. And so you will have essentially been getting this 10% annual interest. Now, when the company does this, they'll probably have to issue some type of new bond, because all of a sudden they have to pay all of these people this huge lump sum of money if they haven't been able to earn it from the factories yet. And we could talk about that in a future video.
Okay, there's one good last look at bonds as we close out the week and finish up assignment number 3. Now, here's what we have going on in the next 2 weeks. And in my last video, I kind of gave you a synopsis of what has happened in the course up to this point and what is going forward. But let me just concentrate on the next 2 weeks. We're going to be getting into what is called project evaluation and investment analysis. In other words, if we invest in an asset, what's it going to cost us to get the money, and where's the money going to come from? Debt, equity, profits. How much is it going to cost us? And then what are we projecting that asset to return for us into the future? Net income plus net cash flow. That's what we're going to be calculating beginning in week 5 and heading into week 6, both those 2 weeks, chapter 8, 9, 10, 11, and 12, is how to determine this, how to determine investment analysis, how to determine the amount of return we'll be getting off that asset, how to calculate the cash flows, how to determine the cost of the capital that we're acquiring. And this is what assignment number 4 is all about, due on October 8th, that will be posted next Saturday on the 23rd. You'll have 2 weeks to do it, and it'll be a spreadsheet. So that's what we're going to be doing in these next couple of weeks. Lots of good information and videos in Blackboard and our YouTube site. Take a look at them, get prepared, and stay up to date. A lot of you are doing very well in this class, but these next 2 assignments, assignment 4 and the final, are going to be a little bit more intense and require a little bit more research to do properly. So if you stay on top of your videos and stay on top of what we're doing every week to week, you'll have no problem. But if you're one of these first 4 weeks that maybe you've watched the video maybe once a week or haven't really stayed up to date with what we're doing, you kind of can get away with it a little bit in the way our work has been and the volume of the work these first few weeks. But that is not the case in these next 2 works, assignment 4 and final. So make sure you plan of spending a little bit more time on this coursework if you want to maintain that A or A minus average, and a lot of us do have A and A minus as averages. It's going to require a little bit more work in these next 4 weeks. But it's been a great first 4 weeks. Again, if you have any questions or comments, please feel free to let me know, either via email. Remember, my email address is rhassey@laverne.edu. My text is 626-818-8652. We have our Zoom student hour links every Thursday night from 6 to 8. And we have our discussion forums in Blackboard where you can post week to week individual questions and comments. So congratulations on finishing the first 4 weeks of our course as we begin the next 4 weeks. Have a great rest of the weekend, everybody. Until Monday, week 5, adios.